The Russian invasion of Ukraine sent world markets into a downward spiral and oil prices surging. Australia's worst one-day fall on the ASX since September 2020 started a global market downturn. As the civilian death toll mounted, Paris and London indexes both lost about 4% before rebounding to close the week. The first financial hit was sharp, but as Deloitte Access Economics' Chris Richardson says, the full economic fallout is yet to be realised.
Look, it's clearly a human tragedy and a pretty large one. It's less clear at the moment that it's an economic tragedy, and perhaps particularly so for Australia. We may be in a better position than most to suffer less from the risks of the moment. For the world as a whole, though, there's still a whole lot of recovery that you would like to see. Any further disruption of this kind is not at all welcome.
If it turns into a very long and bloody war, what could the long-term implications be?
Really quite terrible, basically, because you'd be talking a dangerous geopolitical situation for all the slowly developing tensions of recent years. By and large, the international rule of law has held. Countries have traded with each other. Businesses have been able to trust that things will hold together. If we are seeing a substantial breakdown in those international rules, if the fear is that strong nations will grab opportunities as and when they arise, that makes the world more cautious, makes us more cautious on everything from supply chains to how much we invest in terms of future growth.
Brent crude went up above $105 the highest price we've seen since 2014. Some predictions it could hit $150 What's your view on how high it'll go?
Look, hopefully not that bad, though. To be clear, right now it's really hard to say. And that has an immediate impact. Your rough rule of thumb: every extra dollar on the international oil price per barrel is an extra cent on the petrol price per litre here in Australia. So you're talking a potentially very large impact, and for all the world's attempts to get away from fossil fuels, they remain our major energy source, and if they become more expensive, that becomes more challenging for the world.
That extra cent a litre, of course, it's not just motorists that are going to be impacted by increases like that. There's a whole transport sector that'll be impacted. There's flow-on effects of that. Just when we're seeing inflation rear its head, impacting the cost of all the things that we need in life, those things will all increase too, won't they?
Absolutely. There is nothing more fundamental to costs than the cost of energy. Basically, it's the start of pretty much everything. And so you're right, not just motorists, all sorts of businesses will see their costs rise. Ultimately, that means consumers will see their prices rise. So we are talking quite a challenge, and it comes atop existing challenges for inflation. You already had in the US inflation at 40-year highs, in Europe 30-year highs. In Australia, we're talking 7-year highs, but some continuing risks given what's happening.
And it's a double whammy, of course, when you compare it with wages that just aren't keeping pace. In fact, they're going backwards.
Yeah, or in other words, every federal election brings a lot of talk about cost of living, and it's usually not really on the money. This time it is. This time all sorts of costs are climbing, and perhaps particularly more so essentials. We've seen pain in price increases, food and fuel and health, housing, essentially a range of essentials. And those cost pressures have been on the rise for over a year now. And although wage growth is growing as well, it's starting from further back, and it's got rather further to go.
Energy, of course, a major focus of this conflict. Where does this leave a big energy exporter like Australia?
Well, although there's pain for motorists, it's less clear that when you look at energy as a whole that there's pain for Australia. We sell more energy to the world than we buy back. It just happens that what we buy back is fuel, is oil basically, and Russia produces a lot of it. But we sell a lot of gas. Those prices are rising in response to this. Coal, where it's a little less direct, but it's also a factor that supports prices as well. Chances are that if you're looking at overall costs to Australia, exports and imports, even just focusing on energy, Australia won't go backwards as a result of this.
Speaking of exports, agricultural is also something we export a lot of. So does Ukraine and Russia. They're big wheat exporters. Will that have any play on our economy, the conflict and restrictions and not restrictions with China and Russia doing deals on our economy as well?
Yeah, and potentially so. And it is important how long the conflict lasts. Typically those parts of the world, Ukraine's long been the breadbasket of Europe. Big chunks of Russia, as you note, produce a lot of wheat as well. But they'd be harvesting in the middle of this year, several months away from now. If things have settled by then, it may be a temporary impact. But wheat prices were already high. They're rising even further as we speak. Australia, a big producer, and with all the rain, our crops have been very large in the last couple of years. You would hope that our next crop, and admittedly it won't be harvested till the end of 2022, but that combination of big crops and good prices, not necessarily a bad one for Australia.
Chris, countries including our own are continuing to impose sanctions on Russia. What are the economic implications of that? Could there be any backlash that would hurt us?
Potentially, partly because the world is so intermeshed with itself these days. You saw it when COVID began. All sorts of things that people may have thought would not be affected were affected because a bit of production occurred in this nation and then a bit more in that nation and the like. If you essentially take out Russia and perhaps the Ukraine or some of the Ukraine from world supply chains, that's going to have more implications, I think, than people think. Having said that, best guess is that you're talking, further disruption that is, it's notable, but it's nothing like Australia and the world saw when COVID first hit.
Chris, your final thoughts. What has history taught us about how conflicts like this impact the global economy?
It's bad, right? It's always bad. Basically, economies rely on people trusting each other and trusting each other to do the right thing. Businesses, countries, all rely on trust, and trust today is being hurt on all sorts of fronts. Yes, this is a human tragedy, but there will be economic costs to bear over time as well. We don't yet know how much, but it is an unfortunate thing that's happening.
Chris Richardson, great to have your insights. Thank you.
Thanks.
To the share market, which on Friday tried to claw back some of the $74 billion that was wiped off the ASX on Thursday, but ultimately traded sideways, which meant the ASX 200 and the All Ordinaries both ended the trading week 3% lower. Roger Montgomery from Montgomery Investment Management says while the Ukraine conflict is tragic, war is not necessarily bad for investors.
Since World War II, there's been dozens of skirmishes and minor conflicts. And all of them have produced a relatively similar pattern for investors, and that is the market tends to fall in the prelude to war, and when the first invasions or guns are fired, the market tends to rally, and in fact that's what we've seen again this week.
What do you say to investors who are feeling panicky?
Well, historically there's been nothing to worry about. In fact, a study conducted in 2020 of several dozen conflicts around the world since World War II has revealed that the market tends to fall no more than about 11%, and it tends to recover those losses on average in about 47 days. That's not to diminish, of course, the the great pain and loss that is being suffered by the people of Ukraine at the moment.
What happens though if this becomes a protracted war and it triggers a crisis of confidence?
Yes, well, that is an interesting question because, of course, the background at the moment is rising interest rates on the back of inflation, which is always negative for PE ratios, and it's always negative for equity market performance, particularly when central banks are contracting their balance sheets. And so with that background in mind, it's important to remember that that the pattern of the market may not follow history with respect to its reaction to the outbreak of war. I think it's really important for investors to understand that a rising interest rate environment is always negative for the present value of future cash flows and therefore negative for intrinsic values of stocks.
Where's the safest place for people to be storing wealth right now?
It is actually high quality businesses and those listed on the stock market. High quality businesses are businesses that can generate high rates of return on equity from a sustainable competitive advantage, and they're able to continue generating those high returns by retaining large portions of their profit and reinvesting it at that high rate. In an inflationary environment, what you want is a business with pricing power and a business that can grow its worth.